Welcome to Markets Now. I'm Michelle Rook with Mike Zuzulo, Global Commodity Analytics. Grains opening mixed this morning. Wheat and corn seeing a little pressure. Soybeans to the plus side, and then we're kind of mixed over in the livestock futures as well. And Mike, start off with soybeans because that's the price leader. South American weather and this renewed export demand have been really driving this market, right?
Yeah, and I think the fresh news that maybe is kicking us off on a positive note again this week is the Biden-Xi meeting here at the sidelines of APEC in San Francisco. I think the trade is thinking that we're going to get back on track with the Chinese, especially when it comes to soybeans. I think the problem becomes, though, at this some point, Michelle, is China washing out of soybeans in Brazil and coming to the United States because of weather as well. But that's down the road probably. I do think we're running a little bit ahead of schedule on weather markets in South America. We probably should have taken a pause after the WASDE report, if you ask me, until about Thanksgiving to see exactly what's happening down there. But given the fact that we have both northern Brazil and southern Brazil in two different polar opposite weather extremes right now, I can understand why the trade's so sensitive because the Chinese are moving and so the trade's moving. And I think that brings back into question that major high from September, that monthly high from September around that 1374 level in lead month beans as we see the November go off the board this week.
Yeah. What's your take on the Biden-Xi meetings? Will we get additional business announced? Because we did have the frame contracts that were signed here a couple of weeks ago, and it looks like we've got a lot of that worked into this market already.
Yeah, I think my mindset is their pork industry is in tough enough shape. Their deflation is bad enough. Their consumer is stalled out since the zero COVID policy that they really don't need to buy extra. What they're probably looking and fishing for is some cash injection, some foreign direct investment, because that has been pulled out dramatically from the Chinese economy, and it's really hurting them. And I think President Xi knows that. My issue would be they will find another buyer if they can find it. It is very fortunate for the U.S. soybean grower that we have this weather issue as we go to this meeting, because if we hadn't had the weather in South America, I think we would not be able to be this kind of strength in soybeans, especially after that bump up in U.S. ending stocks. It has to be noted that the Brazil pork price in Paranagua has pretty much collapsed from $520, $550, $515 a ton down to about $460, $470 a ton. That's the logistics. That's probably the cancellations from China. So we're going to have to watch that very carefully.
Yeah. But as we speak, South American weather, you say it's a little too early to put in big weather premium there, but their planting is behind on both corn and soybeans. Get us up to date on that.
Yeah, it is. I mean, we're looking at around 60% on soybeans based upon Saffras numbers. I think Agral would probably be in that same mindset. We're running about 10 points behind. That doesn't seem that bad, but I think what you have to deal with is the northern Mato Grosso farmers are physically not planting. Some of them have not planted over a third or even a half of what they normally plant at this time of year. And that is the big state and province to be watching. Conversely, in the southern parts, maybe they do have 60 or 70% planted, but maybe 20 or 25% now is going to have to be replanted because they're talking about having 20 inches of rain in 30 days with another 5 to 10 inches coming based upon forecasts. But that's probably the biggest issue that maybe makes this a little bit different is the two separate extremes. And it almost nullifies the potential of going into Thanksgiving if we don't see a break in Mato Grosso, in my opinion, for that second crop corn to have anywhere close to what we think we could have had in terms of production possibility.
Yeah, no doubt. Meantime, the corn market is making new lows for the move here again. And so, is that we're still trying to work in this higher yield from the WASDE report? Is that the lower wheat market or what is it?
I think it's a combination. There's no question that the basis levels in the Eastern Corn Belt are plummeting. Part of that is yield, but part of that is wet corn. I've heard a lot of producers telling me that they're seeing elevators close after lunch or after 1 o'clock because they just can't get through the 21, 22% wet corn that they're dealing with. I think this is where the South American market comes back into play, Michelle. At some point, I think the corn is going to have to divorce itself from the wheat. I hope wheat makes its own low before that has to happen. But I think at some point the trade's going to have to wake up to the idea that we're losing supply of corn in South America. I think to your point about the competition side of the equation is what the USDA WASDE numbers did for Ukraine and Russia on last week. They really bumped up the volume too much, in my opinion, on both wheat exports and corn exports for those two countries. And as a result of that, the prices in the Black Sea and the prices at the EU futures market, the MATIF prices, have not been able to find any kind of support. So we're kind of stuck where we have been the last 2 or 3 months, even though export tariff numbers and export quotas have been issued by Russia.
Yeah. But to your point, USDA raised Russian production by 5 million metric tons. So you've got that plus the fact that we weren't competitive with Russia even before that on the demand perspective on wheat, were we?
No, absolutely right. And I think that regenerated the funds to go after and sell rallies. And I think that, again, if that's correct, and this is fund led more than fundamental led because of those numbers coming out, if we see those prices flatten out and start to go up a little bit, I think the funds would be ready to short cover, because I don't think they're really necessarily ready to jump in on the short side. But that maybe the corn yield number here in the United States put them over the edge and said, let's go after new lows because the wheat's not going to fight us.
Yeah. Do you anticipate that demand is going to improve at any time here? I mean, are prices low enough yet that we're competitive, or do we have to go lower?
In corn, yes. In wheat, one of the factors that I did not like seeing this past week was Argentina's price. After a good rain and after knowing that they can't get their crop back, the Argentine wheat prices plummeted as well. And I think that's a really big issue for the market to have to digest. But in corn, that 25 million bushel increase in exports that USDA gave us, I see that going up as we go into the January, February time period. And I am on the camp, and in that camp where the corn yield probably needs to be dialed back a little bit, a half, 1 bushel maybe, because I think the test weights and the wet corn, wet corn eventually, when it gets dried down, is not nearly as good as what you think. And so I think that maybe is something else to be looking for in January.
So cattle, as I mentioned, we saw some weakness on the opening, made some new lows for the move once again, but now we're trying to recover. Do you think that we've gone low enough here in this market? Because, and have we gotten enough of the fund community out of there so that maybe we'll see some pressure taken off too?
I do think both those things are more of a neutral, slightly positive situation than what we had 3 weeks ago. I think we're at a situation now where the Thanksgiving buying by packers is done. The retail market is set for the next 30 days, but I think we are short bought in the packer community at this point when it comes to the beef side. And I was really happy to see the USDA retail index numbers show as good a positive numbers for beef as they did on Friday. So I am expecting a recovery, in part because I think the funds have liquidated enough as well. So I'm telling clients this week 184 to 186 may be the price that we can get again. Because we were, after all, on slaughter down 2.2% on the week. When you look at production numbers, beef production numbers, we're down 5.3% year over year. And when compared to the same week of 2022, we were down over 8% on production. So I do think that lower supply is probably going to catch the market at this point. So I would not want the fat cattle market to take out that 52-week moving average of around 171. That is a level we've not gone below on a weekly close since October of 2020. That probably would spur an additional push by funds to sell more.
Is that basis Dec or Feb?
That would be lead month, so still December.
Okay, gotcha. The other things that the market's going to be watching, though, we do have a cattle and feed report out Friday that kind of started a lot of this catalyst for the liquidation in this last month's report. And then choice boxes have finally fallen below the $300 mark. We haven't seen that for a long time. Are those going to be headwinds?
I don't think so, because I'm of the mindset that because of the strong dollar, and part of the reason why we've gone down, a big part has been this jump in imports and this decrease in exports. I think lower box beef prices helps us not have to import as much, and allows us to be still substantial on the export market. And that was another thing that we saw, what, a 1% gain for the 4-week average on the weekly export sales. China still part of our beef buying program. So I think there's still demand out there, but we're in a situation now where the technicals and the funds should suggest, and the cash should suggest some type of stability in this market.
Gotcha. The dollar, you mentioned that, and it seemed like we had a pretty good turnaround in the dollar index, or it looked like we'd reversed course after the Fed meeting and we left interest rates unchanged. But what do you see in that dollar going forward here?
Yeah, the dollar is acting like the crude oil market in that the trade assumes there's not going to be any problems in the Middle East and that we're not going to have any supply disruptions. By the same token, in the dollar, I think the trade is assuming we will not have a shutdown. I just think in this political environment we're in, we should have more risk premium in these markets in case this market doesn't get what it expects. But I think that's part of the computer generated algorithmic type mindset that we have nowadays. So I think the dollar is carrying a safe haven status that could be wiped away very quickly if we go into a shutdown.
Oh my gosh. Yeah, let's hope not. That date is what, November 17th? We
Friday.
haven't. Okay,
Yeah.
well, let's hope that's not the case. Thanks so much, Mike Zuzulo with Global Commodity Analytics. That is Markets Now.